September 2008. Lehman Brothers has just collapsed. American banks are failing. The crisis is unmistakably made in the USA. So the US dollar should be collapsing too, right? It did the opposite. It soared, against almost everything, for months. That's not a fluke. It's a pattern, it has a name, the dollar smile, and once you can see it, half of global finance starts making sense. Around 2001, a currency economist named Stephen Jen noticed that the dollar kept behaving in a way the textbooks couldn't explain. So he drew it as a curve. Picture a simple graph. On the left side, the world in crisis. On the right side, America booming while the rest of the world lags. In the middle, calm, synchronized global growth. Now plot the dollar. It's strong on the left, strong on the right, and weak in the middle. Two raised corners, a sag in between. A smile. The left corner is the weird one. The dollar strengthening when things break, even when the breakage is American. The right corner is more intuitive. The dollar strengthening when US growth and interest rates outrun everyone else's. That's the claim, anyway. A good pattern should survive contact with evidence. So let's treat it like a hypothesis, and test it against three very different episodes. First, the facts. Between July and December 2008, while the American financial system produced the worst crisis since the Depression, the broad trade-weighted dollar rose roughly 15%. The euro fell from about $1.60 to about $1.25. Practically the only major currency that kept up with the dollar was the Japanese yen, a fellow safe harbor. The Swiss franc climbed against the euro too, so persistently that 3 years later the Swiss National Bank was still fighting the pressure, and finally capped the franc outright in 2011. So why would money run toward the fire station that was actually on fire? Two mechanics. First, the world owed dollars. Banks and companies everywhere had borrowed in dollars. When panic hit and lending froze, they scrambled to buy dollars to repay debts and cut risk. A global margin call is, mechanically, a global dash for dollars. The squeeze got so severe that the Fed opened emergency dollar pipelines, called swap lines, to 14 other central banks, from Switzerland to Japan. Second, safety. In a panic, the world's savings run to the deepest, most liquid bunker that exists, US Treasuries. You simply cannot park trillions in a hurry anywhere else. Verdict, left corner confirmed, in the hardest possible test. A crisis made in America still strengthened America's currency. Now a completely different world. No panic. No crashes. Just divergence. By 2014, the US recovery was firming while Europe flirted with deflation and Japan fought stagnation. The Fed ended its bond buying program in October 2014, and in December 2015 delivered its first rate hike in nearly a decade. Meanwhile, the European Central Bank went the other way, taking its deposit rate below zero in June 2014, literally charging banks to park money, and then launching mass bond buying. The Bank of Japan expanded its own easing. One side tightening, the other side printing. Capital flows toward the higher, rising yield. The euro fell from about $1.39 in May 2014 to about $1.05 by March 2015. The dollar index rose roughly 25% in under a year, one of its fastest climbs on record. Notice what's absent this time. Fear. There was no crisis anywhere. The right corner runs on nothing but rate differentials and growth gaps. Verdict, confirmed again, by opposite conditions. Then came the rare event. Both ends of the smile firing together. On the right corner, the Fed delivered its fastest hikes in 4 decades, from near zero to over 4% within the year. On the left corner, fear everywhere. War in Ukraine, an energy crisis in Europe, lockdowns in China. The result was historic. The broad dollar hit a 20-year high in September 2022. The euro fell below 1 for 1 with the dollar for the first time since 2002. The yen slid to about 150 per dollar, its weakest since 1990, as Japan held its rates below zero. Sterling touched an all-time low near $1.03 during the UK's budget crisis that September. Even the Swiss franc, Europe's classic haven, only held its ground because the Swiss National Bank was hiking too. And then came the mirror image, which proves the mechanism. In the fourth quarter of 2022, as the Fed slowed down and Europe's winter turned out mild, the dollar dropped about 8% in 3 months. Corners released, smile relaxed. Verdict: 3 episodes, 3 completely different worlds, 1 curve. So why does this one currency behave this way? 3 engines. Engine 1, the dollar is the world's operating system. About 58% of official foreign exchange reserves are held in dollars. Roughly half of world trade is invoiced in dollars, whether or not an American is involved. And borrowers outside the United States owe roughly $13 trillion of dollar-denominated debt. Structurally, the world is short of dollars. So when stress hits and credit dries up, everyone needs dollars at once, to repay, to hedge, to survive. Crisis equals dollar demand, automatically. That's the engine of the left corner. Engine 2, refuge. The U.S. Treasury market is the deepest, most liquid pool of safe assets on earth. In a fire, everyone runs for the biggest exit. The Swiss franc and the yen are genuine havens too, but their markets are far too small to absorb the whole world's panic at once. Engine 3, yield. In calm times, capital drifts toward whichever major economy pays more and grows faster. When that's America, the dollar climbs the right corner. And the middle of the smile? When the whole world grows together, rate gaps narrow and nobody needs a bunker, so the dollar sags. That's not theoretical either. In 2017, with Europe and Asia finally accelerating in sync with America, the dollar index fell roughly 10% in a single year. The mid-2000s tell the same story. From 2004 to 2007, the global economy boomed in unison: Europe, Asia, commodities, everything at once. And the dollar spent those years grinding steadily lower. No fear, no American exceptionalism, no smile. Just the sag. Here's why this pattern matters even if you never think about exchange rates. A rising dollar tightens the whole world's finances at once. Dollar debts get heavier everywhere. And commodities priced in dollars, oil, grain, metals, get more expensive in every other currency. Europe lived this in 2022, paying dollar prices for emergency gas with a weakened euro. A double squeeze. Japan felt the other edge that same year. It imports nearly all of its energy, priced in dollars, and it was paying with a yen at its weakest in 3 decades. Import bills exploded. Tokyo ultimately spent roughly $60 billion defending its currency in the autumn of 2022, its first such intervention since 1998. Which means the smile works as a barometer. A grinding, persistent dollar rally usually says the world is either scared, or being outrun by America, or both. Understanding that gives you a lens for reading global stress. It is not, and this matters, a tool for predicting next month's exchange rate. Patterns in macro rhyme. They don't keep appointments. The recap is the curve itself. Left corner, global fear, and a world that's structurally short of dollars scrambling to get them. Right corner, American outperformance and fatter yields pulling capital in. The sag in the middle, synchronized calm. 3 episodes, 2008, 2014 to 2016, and 2022, each lit up a different part of the same smile. If you want to understand the next cycle before it arrives, and recognize these patterns while they're still forming, subscribe. This channel exists to make macro history legible, one mechanism at a time. This is educational content only, not financial advice. Always consult a licensed professional before making financial decisions.